Yeah. Let's put ourselves on mute. Yeah. Okay, can everyone hear me now?
Yes, sir.
Okay,
yes,
okay.
I can hear you.
Okay, so let's put our mics on mute, unless if you want to ask a question, then you can unmute yourself. Yeah. So now everyone knows that I focus more on liquidity. So hang on a minute. So everyone knows that I focus more on liquidity. And like what I was telling some of you guys on the chat the other day, the main thing is to want to spot out a liquidity area that looks like typical retail trader support and resistance. Typical retail trader support and resistance. If you don't know it, you may have to go to a typical trader or go to their telegrams and look at their charts, see how they mark their supports and resistance. That's to look at it. Those support and resistance areas are liquidity areas. That's where to focus on. You're not trading it with them or entering when they enter, but you use it to frame your own trade. You use it in the way market makers use those support and resistance. Now, looking at this, here is a typical support and resistance. You see these two hits. One showed little pin here, rejection. Again, it comes here and it rejected. This is a typical retail trader support. A typical retail trader would be looking to buy again from here. If market comes here and shows a sign of rejection, they will be looking to buy from there. And on the other hand, if the market breaks, just give me a minute, guys. Give me a minute. And on the other hand, if the market comes and breaks this line, they'll be looking to sell from this area. Some would wait for a retest of this red line before they sell. Some will sell immediately. That's a retail trader support. Now, how do you use this to your favor? How you use it for your favor is not to sell or buy when they are buying or selling. Number one is, if you spot this retail trader support, wait for the market to break it. When the market breaks it, the market has taken liquidity. Liquidity in simple terms means money. Means the market is hitting their stops. For example, look at this here. A retail trader here now, looking at this, sees this as a bullish move. From here to here is a bullish move. So the way the retail trader mind works is that it works on is some sort of one-dimensional. What the retail trader is waiting for here is for the market to retrace. to maybe around 50% of the Fibonacci, so he can buy again, which is what he did here. Here, when the market came and hit this 50% of the Fibonacci, the retail trader has bought again here, putting his stop loss in these areas. So here lies his stop loss, and in his mind, he's seeing this area as a strong support because of this hit one. This hit, number 2 hit, he's seeing this as a strong support, and he has bought. And this area, this green area, are laying his stop losses. So when the algorithm or the market makers or the banks come, they will break this support and go and hit all those stop losses. And as they are hitting those stop losses, they are putting money into the Forex market and they are making money, I mean the banks. So your duty here is to wait for these market makers, the banks, the algorithms, the smart money, whatever you call them, to come and hit these stop losses. That is, when it hits them, you can say that the market has taken liquidity. Now, do you trade immediately? No. The market does 2 things mainly. Number one, it takes liquidity. It runs on liquidity. It hits stop losses. Number 2 is that it fills gaps or it rebalances. The market doesn't like gaps. A typical market structure should be like this, where there is no gap. One candle is joining to another candle. There is no gaps. Something like this, no gaps. That's it. That's how, in real sense, that's how a typical market structure should be. Or it doesn't always happen that way. Sometimes we do have gaps, just like we do have here. Here is a gap. We do have here, this is a gap. These are asymmetric regions. The algorithm sees them as being asymmetric, and it tends to come back to fill them. So when the market has come, hit stop losses, you wait for it to fill a gap or a balance, which is, we have a gap here. If it takes this stop loss here, fills this gap, and trades into a swing point, this here is a swing point. This here is a swing point. This here is a swing point. You can also call them order blocks. So when the market takes liquidity, fills a gap, takes liquidity here in this area, fills a gap, here is the gap, this is the gap, or this area there. Fills it, and then trades into a swing point. You know that that market is in a condition, is in a retracement or reversal condition. So you anticipate that the market may retrace here before it continues to sell, or it would reverse here. I hope you guys are following.
Yes, sir.
Now, must it always hold? The answer is no, it must not always hold. Sometimes when they take out these liquidities, here, they are not done with it. It doesn't give them what they require. The amount of volume or the amount of money they put in to sell from here to here is far higher than what they made here. It's disproportionate to what they made here, and they will like to trail down more to hit more stop losses or generate more liquidity, and then they may overrun this one and come to the second one, and this is where they may do the retracement, significant retracement or reversal. But how do we know that this one would not work? So we wouldn't trade it or something. That would be in our entry class. With this one plus what you would learn in our entry class, which will be this week, latest next weekend, by the grace of God, that would help you fish out, sieve out bad trades a lot. And if you follow it judiciously, I can guarantee you'll be hitting at least 70% if you follow it judiciously. Yours is to follow it judiciously, not trading under pressure, not being in a hurry, accepting that it's okay to miss a trade. It's okay to have a stop loss, to have a loss, and then miss the second one, which went your way, and still not get emotional and wait for the third or the fourth. You may trade the first one, it hits your stop loss. You miss the second one and it goes your direction. The third one comes and goes in your direction and you missed it, and you still smile and say yours will come, you will still get one. That's the mentality of a successful trader. Trade without emotion, not being in a hurry, not trading under pressure. Those would be your timelines. Those are the things that would save you in this market. Aside those, you may still be running around the circle. So, like I said, the market will come and trade and clear out liquidity and then fill a gap and trade into a swing point. Those are your conditions to spot out areas of reversal. Now, this area of liquidity should be at least 50% of your Fibonacci, like we did here. I mean, if you buy, this is a swing point. If you want to buy, when the market is here and you want to buy, you must make sure that the place that you spot as your area of liquidity is between this 50 here to around 90 degrees, 90 percentile of the Fibonacci. This is where your area of liquidity should be in. But the best areas of liquidities are here between 50 to 70. These are the best areas of liquidities, between 50 to 70, but you can trade between 50 to 90. So now, having said that, let's go further to look at the charts and see the markups. So look at this here. I mean, there would come a time where you wouldn't need the Fibonacci. I don't really use them. You look at it and you know that this area of liquidity is at least 50% of the, this area of liquidity is at least up to 50% of the Fibonacci. So this here is the area of liquidity. Look at it this way. This is how the retail trader sees it. Hit, hit, and the third hit here, it showed a sign of rejection. Here, the retail trader, so the retail trader this week here is insignificant. This is his area of support, area of resistance for this sell. So the retail trader will be waiting for the market to come back, show a sign of rejection, so he can sell again, or for the market to come, break this area, so he can buy. So and yours is to spot the area of liquidity, which is retail trader support or resistance, and use it to your advantage. So what you'll be looking for or waiting for is for the market to come, take out this area of liquidity, that is, break this retail trader resistance in this case. Fill this gap here. Fill this gap here. And then trade into this swing point. And then you look for signs of reversal or retracement. Our next class, on entry, would fine-tune how to spot out reliable entries. So in other words, we'll be looking at something like this, and then a retracement or reversal. Next one. Here, the retail trader comes here, and this is the area of resistance here. So the retail trader this week is a bit insignificant. Once the market comes here and shows a sign of rejection here, the retail trader is selling. And if it breaks it, they will buy. Some of them would wait for the retest so they can buy. Yours is to wait for the market to break this area. Fill this asymmetric zone here. Fill this asymmetric zone here and trade into this swing point. And you look for area to sell. You look for a valid entry for your sell. Next one. Area of liquidity here. Market would come, break this area of liquidity. Remember, this area of liquidity must be at least up to 50% of the Fibonacci. This one here is around 70. So we're waiting for this market to come back, break this. Okay, I did refining here. So let's drop down to 30 minutes. So you wait for that market to come, fill that gap, and come to this swing point here. Can you hear me?
Yes, sir.
Oh, hang on, it's not. Sorry, I want to see. Okay, this is not a good one. Sorry, ignore this one. Ignore this one, because there is no, it must have to fill an asymmetric zone, and we don't see any asymmetric zone here. So ignore this one. You have to follow it. Okay, on the 15-minute, there is a little one here. That's why I marked it. There's a little asymmetric zone. You guys can see it, right?
Yeah.
Yes, this little asymmetric zone here. Markets to come, break this area, Fill this asymmetric zone here, trade into the swing point, and then you look for a sell opportunity. For the buy area of it, the retail trader sees this as a strong area of support, rejecting with the wicks. 1, 2. Notice this from here now, this from here to here. You notice that the hits or the points, the reference points or the points that form the area of liquidity is not just by the side of the left or just by the side of the right. It's almost at the middle. 1, 2. This one also is not just by the side. It has to be like a balanced pillar, like a balanced structure. Do you guys understand what I mean by that?
Come again.
Okay. Hang on. Okay. So now, what I mean is, if the market is here, and maybe you're looking to sell this market from here, and there is no area of liquidity here. All these are not area of liquidity. The only thing that looks like area of liquidity is here, this one here. This one here. You cannot use this as an area of liquidity for this sell. This is the first leg or the first hit. 1. This is the second. They are just on one side only by your left. It's not a good resistance, judging from this alone. For it to qualify as a good one, you see this hit here, 1. This second one should be somewhere here, or somewhere here, or somewhere here, as if you're building a pillar or a structure. For that structure or that house to be balanced, the pillars, you need 2 pillars, maybe you need 2 pillars. Those pillars, you won't put them together. If you're building a 10-feet structure, a 10-feet decking, at least you put one on the right and one on the left. If you want to build a 10-feet deck and you need 2 pillars, if you put all those 2 pillars by the left, the structure will fall from here, from the right. If you also take these 2 pillars and put them by your right, the structure will fall from here. So these 2 pillars at least need to be here, one here, somewhere here, this area to hold it, or somewhere here, or at least around here, so that it will be balanced. Do you guys understand it?
Yes.
So
Yes, sir.
in using it as using the hits as your to frame an area of liquidity or resistance area. These 2 here are not qualified because they are just together by one side. So that's what you should ignore. This one is okay. 1 here, 2 here, they're almost like the middle, which is the best. The ones that appear like almost they are made in the middle or balanced or have equal spaces, they are the best. This one is still okay. 1 here, 2 here. But if these 2 now if these 2 are just happening somewhere here, then it's not valid. It's not a good one. Are you guys following?
Yes, sir.
Yeah, so we wait for this market here to come, clear this area of liquidity, that is break this support, fill this asymmetric zone, trade into this swing point, and we wait for a buy opportunity. It may do something like this, a little retracement, maybe give you like 30 pips, 40 pips, and then come here. All right, and then come here. This may also fail, but in most cases, before you enter, there are things you see on your entry time frame. And when those things are not present, that's usually when this one fails. When this structure here fails. When those things that you need to see on your entry time frame before you enter are not present, that's usually when they fail. When you see them, most times they hold, they buy up. So it may come do something like this, or even maybe a retest of this. So from here to here, by the time it does it, because you're going to be using 5-minute time entry, 5-minute chart, this is 60 pip movement. In this movement, you may get like 40 pips. Your TP1 and TP2 may be hit in this movement, and then the market will come back. And then this will be a more bigger buy. The same way, you're still going to use this same area of liquidity for the two zones because they meet the requirements. This here is around 60% of the Fibonacci ratio. If you're using this swing point, it's around 70. So you draw your Fibonacci from the swing point you want to trade from. For example, you cannot place your Fibonacci here where it is now if where you want to trade from the swing point is this one that you want to trade from. When you want to trade from here, this swing point, your Fibonacci must be drawn from here. And when you draw it from here, it's around 70%. And then after dealing with this one, you want to also trade with this one. Then you bring your Fibonacci to here. With this, it still meets the requirement. It's around 60%, the area of liquidity. It must be up to 50%. Are you guys following? So let's move to another pair. Guys, are you there? You can send something in the chat to say that you're following or you still hear me. Or maybe you can unmute your mic to say something.
I'm following.
Okay, good, good.
I'm
So
following.
let's come to this. Here is another area of liquidity. Strong support area for retail traders. Again, if you do this, the retail trader seeing this buy here has waited for the market to come to 50% or 68%, something like that. And then 68% will be somewhere here, retail trader Fibonacci ratio, and they will have bought here now. Retail trader has bought. And when the retail trader buys here, usually they are always looking to take profit here. At least most of them are always looking to take profit at the peak. Usually the TP1 is here, and then they're expecting to take TP2 here or above. So when they are bought here now, their stop losses are lying here. The algorithm, the computers, the market makers, they see all those stop losses and they will come back for them most of the times. Sometimes they will allow you make it and be happy with yourself and also be hopeful. But most of the time they will come and crush those stop losses. So they will come here. So assuming that this market now keeps going up, you're not in this trade. You've got nothing to win or lose. Let them do their thing. The market retail trader would win some here, but most times they will come back for these stop losses, clear them. The algorithm will fill the gap, this gap here, trade into this swing point, and then you'll be looking to buy from here. I want to see what made me, yeah, I think.